I'm thrilled to be introducing our first session today. A year ago, supply chains looked pretty different to how they look today. We faced high levels of consumer demand, soaring freight rates, supply chain blockages, and almost a year ago to the day, Russia's war had just started. We're now 2 months into 2023, and a lot has changed. Energy prices soared, seem now to be coming down. Freight rates have clearly fallen, and consumer demand has dropped off quite a bit since the summer. Retailers are now experiencing a destocking period with high inventory levels, although again, in some instances, that seems to be normalizing, but are also thinking about how to manage a potential rebound in consumer demand in late Q2 and certainly into Q3. So, what's next for inventory and demand over the course of this year? That's what we'll be talking about first today, and who better to join us for this discussion than Richard Lim, who is the CEO at Retail Economics, a leading voice in the retail industry. And we'll be talking about what's next for consumer demand, how it will affect inventory levels, and our predictions for the coming months. Welcome, Richard. Do you want to maybe give a quick intro on yourself?
Brilliant. Yeah, no, thank you, Alex. So I'm Richard Lim. I'm CEO of Retail Economics. Retail Economics is an independent economics consultancy. We're focused specifically on retail and consumer industries. So essentially, we put economic analysis, econometric modelling, forecasting at the heart of what we offer our clients in the industry. So delighted to be here this afternoon for this event with Zencargo.
And welcome, Richard. So we're going to be talking about the outlook, the inventory outlook, the demand outlook, what people can do in this environment. But to set the scene a little bit, I think the trading environment is tough, but perhaps not as bad as we thought it might be. The economic headwinds were looking harsher towards the end of September or October compared to now. And if we look at this quote from Andrew Bailey, the Bank of England governor, who says that he thinks inflation will come down rapidly. Now, that doesn't necessarily mean that we'll be seeing deflationary trends. And of course, retailers are seeing still pressures from consumer spending and cost of living. We have the UK dollar exchange rate being volatile, and maybe that will be a second wave of impact. But it's unclear whether the UK will enter a recession, and it will certainly be shorter and less severe than previously thought. What I find interesting is when we think about inventory levels and we look back to the early 2000s and also to the global financial crisis in 2008 to 2010, where in both environments, what we saw was demand falling, inventory levels falling further, i.e. going through a destocking environment of 2 to 3 quarters. But then afterwards, some retailers got caught short. And what you saw was 3 or 4 quarters after destocking started, you had a restocking environment. And I think it's going to be very interesting to see, coming towards the end of Q2, whether those same dynamics played out. Clearly, the big difference from both of those events of the past is the inflation level. In 2001, 2002, or 2008, 2009, inflation was relatively muted. You didn't have double-digit inflation levels. And even if inflation comes back down, we still would have gone through this significant wave of inflation. So what are we hearing in terms of market inventory levels? I would say, firstly, nobody knows if we're going to have restocking. Everyone thinks that we're getting to a point where inventory levels are starting to balance out so that new volumes in will equal demand. But that doesn't mean that we're going to have a restocking environment. When I speak to many businesses, and we'll come on to this later, people are still cautious about Q2, but not really sure about what the future holds beyond that and how they should adjust their strategy. Richard, I'm not sure what you've been seeing and hearing.
Yeah, no, thanks for that, Alex. And I guess, taking kind of a step back and looking at the wider macroeconomic environment, I definitely agree with the sentiment that you've put out there. And I think towards the end of last year, the whether it's the Bank of England or many other kind of economic forecasting houses, I think the expectation was that the economy was likely to see a deeper and longer recession than we're currently expecting at the moment. But the reality is that we're still heading into quite a challenging condition. We've got inflation that's still at double-digit levels. We've got interest rates that have risen for 10 consecutive occasions, and so there's a kind of a real squeeze on people's personal finances. And confidence has been hit as well. So confidence levels were at record lows at the end of last year, but they have recovered since that period. So I think there's still lots of challenges. I think the economic environment has certainly improved over the last 3 to 4 months specifically. And I do think that there is room for optimism. I think there's room for optimism because some of the other factors and headwinds have softened from a retailer perspective as well. So we've seen input costs that have fallen quite rapidly over the last few months. We've seen an ease in things like freight costs over the last 9 months or so. We expect inflation, as you've already called out, to fall rapidly. So we've gone from a peak of 11% at the end of last year, and we think inflation will be nearer 5% towards the end of this year. So we're likely to see kind of a rapid fall of inflation, and that feeds through into consumer confidence. So there's lots of room for optimism. And I think heading into the beginning of this year as well, kind of going into the kind of the inventory picture, if you like. I think heading into the beginning of this year, what we've seen with the clients that we work with, and also from some of the official data that's out there, is actually conditions are probably better than expected. Retail sales have held up better than expected. Consumer confidence has probably held up better than expected. And so actually, although towards the end of this year and heading in towards the end of last year and heading into this year, inventory levels were higher than many retailers would ideally want, they've managed to reduce inventory levels, some of which have been obviously sales driven. But generally speaking, I think the picture is a bit more optimistic than the end of last year. Inventory levels have reduced, and consumer demand has probably held up better than many expected. But it's a mixed picture. I think that the key thing is it's a mixed picture across different sectors.
And that's what I'm hearing as well. I think businesses are still conservative with the orders that they're raising, so the purchase orders that they're raising for Q2 and with inventory levels in Q1. Some obviously are holding back inventory and not doing any aggressive discounting because of a strong balance sheet. But it really gets me curious about what the market might look like in Q2, because if we get to the middle of Q2 and to your point, if trading is holding up stronger, or if there's an expectation that with, in the UK, the coronation coming up, people are starting to get excited about what, life after Easter might look like from a demand perspective. I do wonder if we're going to start to see that inventory overhang quite quickly turn into people thinking about how do they get their hands on more inventory, which leads us to the next question, Richard. Do you have any predictions on what demand might look like over the course of the year?